David, I've never seen you, as well as other strategists, have to downgrade their earnings forecasts so quickly. How do you have any visibility right now?
Well, it's an excellent question. Good morning, Alex. It's been challenging, the swiftness with which all of this has played out, really, in a real-time basis. So you're correct. At the end, towards the end of February, we made our first cut. We saw things were slowing, and then in early March, and then last week, we reduced our estimate significantly. So we're looking for this year, in 2020, about $110 of earnings for the S&P 500. That's down 33%, and so that's a significant decline. Obviously, we're expecting a rebound meaningfully next year, almost 55% towards $170. But the key driver is that we are still in the first quarter, and we haven't even begun the second quarter, which is likely to be the most significant contraction in the U.S. economy that we've really ever seen in a single quarter. And so as a result, Alex, that's really the driving force. So if you think about it sequentially, we've got earnings down 15% year over year in the first quarter, actually down 123%. So literally there will be a loss across the U.S. Publicly traded companies in the second quarter, down year over year growth, declining around 21% in the third quarter, and then we're up in the fourth quarter by 25%. So that's the general sequence. And that's generally the path of the equity market that I anticipate. The market troughs somewhere around the 2,000 level, and then rallying back to 3,000, as you said.
So before we get to specific ideas, investment ideas, does the stimulus that's going to get passed in Congress, the $2 trillion, does that change how you view or have to model earnings?
So we were anticipating, along with our economists, a meaningful amount of stimulus. This is certainly at the higher end of that range, almost 10% of U.S. GDP. That tantamount to the amount $2 trillion, about 10% of the overall economy. So that is an important stabilizing mechanism that we incorporated in our analysis. And clearly, the Federal Reserve has made some extraordinary moves in different areas of the financial markets, commercial paper being a particularly notable one. And as a result, that has given us more confidence that ultimately the economy will be growing in the second half of the year, and we'll in fact get a renewed growth in profits and business. I think the simple issue is many companies literally have no revenue coming in the second quarter, or if you will, no revenue, meaning very, very substantially reduced revenue. And this is why at the end of the day there's a loss. A lot of small businesses clearly at risk. So there's many dislocations that are happening, which is taking the profit level down for this year, which has come to the most significant discussion point with portfolio managers in the last really 2 weeks, which has been how does one assess a normalized or a run rate of profits that companies can generate. So one of the ways we did this was to look at what we call a margin of safety. So if you're a fund manager, an investor, do you have a margin of safety when you own a stock, when you buy a stock? And this is an old approach that Ben Graham, father of value investing, used to look at, which is let's slash a estimate or let's adjust it to a particularly low level that we think is kind of as low as you're going to go. And so this year there's not a lot of visibility. We have a model, of course, we published some estimates, but let's look at the 2021. Let's take a 2021 estimate. Let's reduce that earnings estimate by 20%. First of all, analysts are typically 10% too high, so that'll take us down by 10%. And then we'll also be conservative, and we'll take that down another 10%. So we'll take that level of earnings, look at the valuation, Alex, on that stock, and compare it with where those stocks traded at the bottom of the market in the March of 2009. And say, if I'm buying at a lower valuation, you look at stocks, some of them trading on this adjusted valuation approach at 14 times earnings. They traded 18 times earnings in March of 2009. So that would be a margin of safety. That's an approach of choosing stocks, and I think it's appropriate at this particular juncture.